let's say in this IT sector, but it should never happen. I should diversify my portfolio to various sectors. Okay. RBI has also given the restriction on this. You cannot give more than 10% of your tier 1 capital to any single borrower. More than that. Okay. So these are the unwritten principles of loans. Safety of funds, purpose, liquidity, profitability, security and risk spread. Got this? These are asked in exam. In exam you get this question, unwritten principles and 1, 2, 3 and then all of the above or something is not given from here. Okay. What are the various types of borrowers you get? The borrowers can be individual borrower. Individual means what? Normal human being, anyone. Okay. Then it can be sole proprietor, partnership firm or joint ventures, HUF, companies, statutory corporations, trusts and cooperative societies. There can be someone more also. There can be a startup, but startup comes in this corporation only because it's a company. Company it comes in. So basically, if you look at all these borrowers, you'll notice one point. What is that point? The borrowers are either natural borrower or artificial borrower. Okay, borrowers are either not natural or artificial. Natural means what? This individual. Individual is a natural person. Okay. Artificial means which are prepared by papers, which are created by papers. Now, who is created by papers? Proprietary firm. We create it. Shop Act, right? Shop and Establishment Act. Good morning. Shop and Establishment Act. We created. Partnership firm. We created. Partnership document, right? Agreement. Joint ventures. We created. HUF deed. We created. Companies. MOA, AOA. Okay. Certificate of registration. So we created. Papers. Statutory corporation again created by government of any state or India. So government again by paper. Trust created by paper. Cooperative societies created by paper. So there are only two types of persons or borrowers. One is natural, second is artificial. Natural means the individual who is born. Sure, I'll give you a very simple example. How to classify? Suppose if you go anywhere or if I see you, I meet you, I can see you. Even if your Aadhaar card is lost, your ration card is lost, all your documents are lost. There is nothing, no document, no record of yours. No record. Even in the government, let's say your Aadhaar number gets destroyed. Then also, this natural person is living. I can see that person. So that's why natural person actually doesn't need any document to prove himself, right? But artificial person, if I lose all the documents of this firm, even the government records are destroyed, then this artificial person won't exist, right? So that is a basic difference. What is the trust? Many of us know only hear about this trust. Do you know anything about trust? Trusts are of two types. One is government trust, means this finance trust, government finance, and second is private trust. Okay. Trust has three parts. From the banking perspective, kindly note, trust has three parts, three elements you can call it. Sponsor, trustee, and beneficiary. Sponsor means those who are giving the funds for that trust. Okay, those who are giving the funds for that trust. Okay. Then trustee means those who are working in that trust. Working. And beneficiary means for whom the trust is there. Whom. Okay. So generally, see here, all these things which we see now, government has closed this NGO, that NGO, all these NGOs are closed now. Entities can be artificial, also legal entity. Yeah, you can say that. Correct, Prabhakar. You can say that definitely. It's a legal entity. Here, you see those news nowadays. Government has closed 200 NGOs, 2000 NGOs. Why were these NGOs closed? Do you know why? You hear this now? Have you heard this news? Government is closing these NGOs, that NGOs, that illegal funds are coming. So everything relates in these three elements only. See, the whole game is between these three elements. The whole game over here. Who gives the funds? Sponsor means the one who gives the funds. Trustee means the ones who work for the trust. And beneficiary means for whom the trust is run. For the poor people, for many of the trusts are run, not many, some of them. I won't say many. Some of the trusts are run just to create the civil war in the country. The beneficiaries are shown differently and they are different. So that's why we have to be very particular about whenever you have a trust account. You have to be very particular about where the funds are going, whether they are actually going for the purpose for which the trust was established, or they are going to someone else, or in the name of these poor people are the funds going somewhere else. So you have to check everything. Okay, what are they governed by? Look at this. Individuals are governed by Indian Contracts Act. Partnership firms are governed by Indian Partnership Act. HUF is governed by here. Now this customary laws pertaining to Hindu. Now HUF is governed by whom? See, there are two rules going on in our Hindu society: Mitakshara law and Dayabhag law. They call it Dayabhag. So HUF is created under Mitakshara law, not the Dayabhag law. We follow Mitakshara law. Okay. Now those who want to study this in detail, what is Mitakshara law? Go and study. Not required in your banking. In your banking only it's required Mitakshara law and Dayabhag law, because this is a deep study. Actually, I've studied this. I've given some hours for this earlier. I'd studied a lot about Mitakshara law and Dayabhag, but it's not required at all in banking. Okay, you only need to know the names and the and you need to know that HUF is governed by Mitakshara law, not the Dayabhag law. Okay, companies are governed by Companies Act. Statutory corporation. What is statutory? Statutory means the government created corporations. Okay. Yeah, government created corporations. So statutory corporations. Yeah, one sec. Statutory corporations means which are created by the government. So which is a statutory corporation? Yeah, I'll send it, Suresh. Which is a statutory corporation? I'll give you a simple example. NHAI. Okay, NHAI. Let me write it over here. This. NHAI, National Highway Authority of India, NHAI. Okay, so these corporations which are created by the government, okay, so they have their own acts, own rules and regulations, so they'll follow it. Generally, they are same. 99% all the rules and regulations of government organizations are same. They can be changed, isn't it? Logically, you can change these rules and regulations. Okay, so the point over here is one second. You wanted the this na add members. Yesterday somebody showed me in CIB or JIB. They showed me, yeah, how to add the members. See this. I've given you the link. Okay, Suresh. It's a WhatsApp channel. Okay, kindly join this channel, everyone. Okay, not channel. It's actually a group. Okay, WhatsApp group. So you can query also over there. Okay, chalo. Let's move on. So HUF, Companies Act. Statutory corporation acts created the act that created them. Trusts. Trust means Indian Trust Act, Public Trust Act. These are Religious and Charitable Endowments Act. So three Acts are governing it. Indian Trust Act, Public Trust Act, and Religious and Endowment Act. N- Okay, nowadays you are hearing that now. All the news in the newspapers and web portals that from the government control, remove the mandirs from the government control. That is under this only. All these three: Indian Trust Act, Public Trust Act, and Religious and Charitable Endowments Act. Work fact. So it is governed by again this cooperative work fact cooperative societies. No, that is different. So this, yeah, work fact is also governed under this only. Okay, means in fact these trusts are governed. All these are governed by this work fact also. Okay, yeah, Cooperative Societies Act. So it is governed by Cooperative Societies Act or Societies Registration Act. Two acts are that. Now, cooperative societies is generally governed is a state subject. Okay, that's called as a state subject. So these are in the hands of states generally. Okay. So importantly, remember you will be asked about one, two, three statutory corporation trusts. They won't be asking that much. First four are definitely asked up to NHAI. This part they are something is asked in this. Okay, generally this cooperative and this trust act they don't ask you because why? Why don't they ask you? Because these organizations generally don't take the loan from the banks. These organizations don't take the loan. Loans are taken by these above ones. Okay, these guys only have the accounts with you. So generally in CAIB they'll ask you only first four. Okay. Now what are the types of credits? Now the types of credits can be fund based and non-fund based. What is the difference between fund based and non-fund based? Fund based means where I actually give the funds. Cash is given. That is known as fund based. Okay. Actual transfer of money from the bank to the borrower is done. Actual transfer means what? Cash credit, CC, term loan, pre-shipment finance, post-shipment finance. Your home loan, I'll actually give the money to this guy. Okay. It can be divided into short-term credit and long-term credit. What is short-term credit? Short-term means which is within 1 year. Which is within 1 year. Okay. So within 1 year means it can be CC, term loan, not term loan, CC, OD. Okay. All these are short-term credits. What are long-term credits? Long-term credits means which are more than 1 year. Term loans. Okay. Generally, there is a classification: short-term, medium-term, and long-term loans. We classify it in our banks. Okay. But that classification in terms is in terms of term loans. Don't mix this. What happens is I'll give you the logic over here. The loans are classified into two types: term loan and OD. Okay. Term loan means what? Your EMI is paid. OD means what? Your EMI is not paid. Okay. Now in OD we have various types of ODs: cash credit, pre-shipment, post-shipment, gold loan, then anything else which does not have EMI. Got it? So that is OD. In term loan, you have to pay EMI. Now these term loans are also classified in three parts. Okay, short term loans, this short, medium, and long. Short, medium, and long term loans. Okay, these are the three classifications of term loans. Short is less than 3 years, 3 years, 3 years to 7 years, and above seven. Okay, above 7 years. So this is the basic logic of term loan classification. Okay. So coming back, nobody is going to ask you this 3 years, 7 years. Okay, it's just for your information. Now, that is fund based. But what is non-fund based then? In non-fund based, you don't directly transfer the money, but you give a trust to them, a word to them. Zuban ki कीमत. There is no transfer of money, but a commitment by the bank. एक बार मैंने कमिटमेंट कर दिया तो मैं, व्हाट इज दैट डायलॉग? एक बार मैंने कमिटमेंट कर दिया तो मैं खुद की भी नहीं सुनता, isn't it? खुद की भी नहीं सुनता. So same thing. Once you give the commitment from the bank, you can't back off. You can never back off. Okay? That is the problem with the banking bank. See here, what is the means? I'll give you the examples. One is LC, letter of credit, letter of credit. Second is BG, bank guarantee. These are the basic fund, non-fund based this activities. There are many others, but main are these two. So it may result in future transfer of money to beneficiary of such commitment. So it may result. What do you mean by this? I give you the word, I give you the commitment, and in later if you don't perform, in that case I'll have to pay. Right? What are the examples? Bank guarantee, LC, co-acceptance of bills, forward contracts, derivatives. These are all non-fund based, where you don't pay the money right now, but in future you may be required to pay. Co-acceptance of bills means what? It's also called as availization. Okay? Co-acceptance is also called as availization. What is co-acceptance? Co-acceptance means the customer accepts the bill of exchange. And in addition, you also accept the bill of exchange. Let me see if I have given it over here. No. See here. In co-acceptance, what happens? There is a bill of exchange which is accepted by the customer that yes, I agree to pay on the due date. Now the seller does not trust this buyer. Buyer says you agree to pay. But what if you don't pay? Who will guarantee me? So in that case, bank comes ahead. And banks also puts a stamp on that bill of exchange. That see, now I have also put a stamp. Then what is that stamp? If this customer doesn't pay, then I will pay. Bank will pay. So that is what co-acceptance. Two persons have accepted it. Okay. What are the business segments in banking? Various business segments. One is treasury. Okay. What is treasury? Treasury is the prime function of treasury department of any bank is to ensure that the assets match its liabilities in every possible way. One thing you call treasury anything. We speak about treasury. Treasury is this, that, that. Basic job of treasury is to focus on less than 1 year problems. Okay, less than 1 year problems. Main job of treasury is that. Okay, to match the assets with the liabilities, mainly in the short term. Mainly in the short term, not long term. Of course, long term is also required, but 90% focus is on the short term. Okay, what do you mean by short term focus here? Assets matching with liabilities. What do you mean by assets with liabilities? Very simple. My how many loans of mine are there and how many deposits of mine are there. Loans match with deposits. Now these can be in various forms. These can be deposits, means I can have deposits from the customers, or I can have short-term borrowings from the from some other parties. In any ways, cash flow comes in. In loans, I can have loans or I can have short-term bonds. So what my job is to match my loans and bonds which I'm having with my borrowings and my deposits. That is my job of treasury. Kindly note. Okay. So here I'll give you right over here for easy understanding. See, it's like this. Bank always has what are the bank always works in two parts, right? One is sources of funds, sources, sources of funds, and second is application of funds. Application means where I apply the funds. What are the sources of funds? Deposits, deposits, right? From here, I take the money from the customer. Second is your borrowings. Borrowing means what you borrow from others. Loans. Simple meaning is loans. Okay. Then what are the application of funds? Application of funds are loans which you give. Loans given. Okay, loans given. And second is investments in bonds. Whatever I invest in bonds. Invest in bonds. Okay, so these are the two sources and application of funds. And what is the job of treasury? The job of treasury is to match these two sources with application. This is the basic job of treasury, to match. Okay, got it? So treasury's main function is to match its assets with its liabilities in every possible way. Now there is a bucket system given by RBI. The bucket system starts from overnight. Overnight to it moves on. Okay. Second is wholesale banking group. That means corporate banking. Wholesale banking's other name is corporate banking. So wholesale banking is the provision of services by banks to larger customers or organizations such as mortgage banks, large corporates. Forget all this thing. Simple meaning, wholesale banking is a loans given to the big customers. You look at this: mortgage brokers, large corporate clients, mid-sized companies, real estate developers. So these are all big companies. So that is basically corporate banking. Okay, corporate finance. Now, what is the difference between this banking and finance? In corporate banking, we mainly have, see here, banks to larger provision of services. Now, look at this. Here we are talking of services. Services means what? Here we are talking of various accounts and all this. Mainly we are talking of liabilities over here. Okay, liabilities and other services. Here when you say finance, it means clearly finance. Okay, financial services necessary for like funding. Here we focus on funding. See, to be frank, these two are same only. Now these words are given differently. Corporate finance and corporate banking. It means one and the same. In corporate banking only we give the loans. Okay. So capital structure. I worked in this corporate finance, corporate banking many years. The minimum loan given in corporate banking is, anyone knows? Generally, I'm talking of general terms. The minimum loan given in corporate banking in big banks. I'm not talking of small banks. Minimum loan given is around 500 crores. 500 CR is a minimum loan given. Okay. So corporate finance means fundings, capital structure, allocation of finances, and more. It is largely related to financial planning, how finances must be implemented at various stages of business. See here, various stages, finances must be implemented. Planning means what? Cash flow statement. How does the cash flow statement work? Means how, where will I require the cash? Where all will I require the cash? That's what is checked over here. Okay. So cash flow statement. Next, credit management. The basic function of bank is giving credit to the customers. It doesn't end here. It is a process that covers various stages of granting credit to its recovery. Now see, this credit management includes loan giving also, sanctioning also, plus loan recovery also. All your NPA management is also comes under credit management. These are separate chapters to you. You'll see them as the chapters now. Credit management also includes setting up terms and conditions, policy of agreement, analysis of risk factors, and other related functions. So, credit management includes these all terms, setting up of terms and conditions, policy agreement, all these. Okay. So, basically, managing the loans from sanctioning to recovery. Asset management. Asset management means this is generally more than 50 lakhs and above. The segment takes care of the money owned by corporations and individuals. This segment of corporate banking directs and decides where to invest the money. Now, there's a service given under asset management that's called as PMS, Portfolio Management Services. Now, for individuals, here I'm talking of individuals, it is more than 50 lakhs. Individuals. If I'm talking of companies, then it depends on bank to bank. Okay, the criteria is decided by the banks. But what is asset management? Managing the funds of that company. Many companies have so much funds, okay, so much of the funds that they can't even think, okay, that much rich they are. Vaishalini, I've just given this WhatsApp group. Yeah. No, not CC. It's a total credit. That is called as short-term credit. Short-term credit is totally different, Vaishalini. 5 crores means when I say 500 crores is the minimum loan given. So 500 crores is not related directly to CC. There is a separate term called as short-term loan. STL we call it. In STL what happens? You give them unsecured loan without any security. Only based on the name and fame of that company. Big name. Like Reliance comes to you for 500 crores. You give it without any security. Okay? Yeah. Take this. Okay? So, cash management. Cash management means this segment ensures efficient collection, distribution, and investment of cash in an organization. So, cash management means basically you will be focusing on cash flow statement. Where will I require the cash? At what point I'll have excess cash? At what point I'll have lower cash? That's what is checked. It ensures efficient implementation of resources and various other financial operations. Okay. Loan management. Corporate banking involves a specialized loan department that oversees the process of granting loans to the corporations. So, specialized loan department that oversees the process of granting loans to the corporation, giving the loans to the companies. Okay. So that is basically loan management, compliance with the credit regulations and other management related functions. So basically compliance and granting loans. Okay. Retail banking. This is the most common segment which we know. Retail banking, right? The role of retail banking is to help individual consumers manage their money, gain access to credit, deposit their money in secure way. Retail banking offers current account, saving account, mortgage, personal loan, credit. This you know already. Credit cards and CDs. Nowadays we have FDs in our country, but many of the foreign company banks have CDs, certificate of deposits. Instead of FD, they have CDs. Okay. Retail banking is the most important segment in our banking today. Why? Because 90% of the loans in numbers is less than 1 lakh. Do you know? 90% of the loans given in our country, Bharat, okay, are less than 1 lakh. In numbers, I'm talking. Huh? I'm not talking of amount, numbers. Okay, that's why retail banking has gained much importance now. There is something called as savings current. Instead of current account, nowadays we have checking accounts. Have you heard this name, checking accounts? How many of you have heard the names checking account? What is the checking account? See, your checking account is actually a current account. But in this current account, you cannot deposit cash or withdraw cash. Cash is not allowed. You can only do the fund transfer through NEFT, RTGS, UPI, check, anything, but no cash. Okay, so that is basically checking account. If you deposit cash or withdraw cash, this account gets transferred into your current account. Then MAB is required. In checking account, it is zero balance account. You need not maintain any balance in this for checking accounts. Okay. Wealth management, another segment. It's a quickly growing segment for the banks. Revenue generated through retail brokerage service. We are acting as a broker over here. Okay. It is more profitable due to lower credit requirements, lower volatility, and greater growth. Now, under Basel norms, there's something called as Basel norms. Now, you'll be studying this in your BFM a lot. Under Basel norms, we don't require much capital for your for this wealth management. For loans, we require huge capital. There are haircuts, there are various regulations for loans. But for brokerage services, there is very less capital required. So that's why all the banks are now focusing on wealth management. Because what happens, you are acting as an agent. Okay, I'll give you a simple example. Suppose if you are acting as the agent for insurance, you sell insurance to somebody, and tomorrow if that person dies, what is the harm to you as such? You as a bank, there's no harm to you. Why? because this insurance was of some insurance company. Let's say SBI Life. You are working in State Bank of India, SBI. Insurance is of SBI Life. It is taken by your customer. Tomorrow, if that customer dies, the money is to be paid by whom? The money is to be paid by SBI Life, not SBI. So SBI has only got a commission. Commission is also huge. It goes up to 30% of the first premium. So if you have a premium of 10,000, you get 3,000 as a net income as a bank. Okay, so it's so huge. That's why all the banks are going for it. What are the components of credit management? So the components of credit management are, means basically what do you mean by this word? Components of credit management. Components of credit management means how the credit means what are the elements of loans. To be frank, what are the elements of loans? Loans. What do you mean by this? It means from start to end, how the loan is handled. Now this is actually the summary of your module C. Summary of your module C. You will see all these chapters in module C. All these chapters. So first is loan policy of the bank, credit appraisal, control and monitoring, rehabilitation and recovery, risk management and identification, measurement and evaluation, delivery of loans, and refinance of loans. So all these are the components of your loans. Okay. You will see all the chapters. This you can call it as a summary of module C because you're having all these chapters over here. Got it? So coming back to this point, now let's discuss this some more in a bit detail over here. Of course, we'll be discussing it later also. Okay, but to some extent, let's discuss this. See this loan policy of the bank. Who prepares the loan policy? The loan policy of the bank is prepared by board of directors. Okay, board of directors means it is not actually prepared by board of directors. It is prepared by anyone in between, means some senior management officer, someone or some team. It is signed by board of directors. Signing means what? It's your authority. Okay, so loan policy of the bank is actually signed by board of directors. So loan policy of the bank signed by BOD. What does this policy include? This loan policy includes various terms related to sanctioning, collateral, NPA. All these means totally in and out of the loans are included in this loan policy. Credit appraisal. Now everything else, see here, credit appraisal, monitoring, rehabilitation, everything should be included in the loan policy. Okay. So credit appraisal means what? Credit appraisal means appraising the credit means what? There are three types of credit appraisal. In fact, there are seven types of credit appraisal. Main are three: management appraisal, financial appraisal, and technical appraisal. These are the three main. There are others also. Okay, let me write it so that it becomes clear to you. Three main appraisals are there. Say this. Okay, one is technical appraisal. Technical. Second is management. Management. And third is financial. Now there can be many. As I said, there are seven appraisals roughly. Seven. But these are the three main. There is environmental appraisal, there is legal appraisal, many are there. But main are these three. 99% of the topics or the loan is covered in these three only. What is technical appraisal? Look at this. Technical means many of us think that technical word means related to technique, related to maths, but it's not that. Technical appraisal means actually going to that place, visit, visit, okay, going to that place, checking where the suppliers, where from how far the company is located from the road, main road, What is the availability? What is the electricity availability? Means checking physical things over there. That is technical appraisal. Are the workers working in the factory, or it's just for namesake the factory has been opened? So that is technical appraisal. So kindly note, technical appraisal does not include any ratio analysis. No ratios are included. Okay, it's purely visit and checking the physical things in the factory or the site area. Then management appraisal. In management appraisal, we check the uh, who are the persons in the management. What is their financial background? Has any one of them become NPA earlier? It can happen that in the board of directors or the senior management, there are certain persons who are earlier NPAs. So for such persons, we generally don't give the loans. Okay. So credit appraisal, that is management. So we check the human being behind the companies. Third is financial. Financial is very simple, ratio analysis. You check various ratios of the companies, right? In those ratios, you decide, based on those ratios, we decide whether to give the loan or not. All the three are equally important. But very important is, firstly, financial ratios should fit in. Okay, if they fit in, then only you go for other things. Generally, what happens, your technical visit happens at the last. Because what happens, if the customer, what I've seen in banking, when you do the visit, the customer feels that yes, loan is now sanctioned. That's why visit is generally done at the last. Have you worked? How many of you have worked in loan department? In loan department, those who have worked, you might have experienced this. Once you do the customer visit, the customer feels that yes, yes, now everything is done. Loan is sanctioned. Tomorrow the loan will be disbursed. That's what the customer feels. So that's why technical appraisal is always done at the end. Never do the technical appraisal visit at the beginning. If you do the visit at the beginning, I'll tell you the customer will kill you. He'll come to you daily in the morning. Sir, हुआ क्या लोन? विजिट तो हो गया. हुआ क्या लोन? विजिट तो हो गया. Customer doesn't understand. Visit is not a full and final thing. There are many other points, but customer doesn't understand that. Customer understands that once visit of the branch manager or the senior person is done, it means the loan is to be disbursed now. So that's why always do the technical visit at the end. Never do the visit in the beginning. You'll go mad. Okay? Means I've experienced all these things. Then controlling and monitoring. What is control? Control and monitoring means controlling the loans. Okay? Rehabilitation and recovery. What do you mean by monitoring here? Monitoring means basically checking the stock statement, whether the customer's DP is proper. This is mainly in CC. Okay, in term loan, it hardly matters anything because once the loan is disbursed, only the EMI is to be checked. Rehabilitation and recovery. In case of NPAs, how to rehabilitate the loans? Now these are two parts over here: rehab and recovery. Rehab is done for genuine defaulters, genuine, and recovery is done for willful defaulters. Who are willful? Willful means those persons who are having the money, but they are not giving. There are many, right? Vijay Mallya case, Nirav Choksi. Okay, all these are famous cases. They had the money, but they didn't give. So rehab and recovery is for that. Rehab is for genuine customers, those who actually want to come back. Risk management, identification, measurement, and evaluation. All these means total risk management in our loan system. It includes from your sanctioning to your disbursement to your recovery, everything is included, to your rehab. Delivery of loans. In delivery of loans, you'll be looking at legal documents. What all legal documents are taken? Whenever you give the loan to that any customer, you take financial documents. Three types of documents are taken always in any loan. One is financial documents. Second is collateral documents. And third is your legal documents. Legal documents are taken after the sanction, before the delivery or disbursement. Okay, so that is this delivery of loan requires legal documents. Kindly note. And then refinance. Refinance is a separate aspect, giving loan on loan. That we'll discuss later. Now, what is loan policy of the bank? Serious, I told you now, each one you are having separate topic. So today we'll be covering loan policy, okay, and this five C's of credit. Let's see. Based on the general principle of lending stated above, these general principles which I have stated, CPC, Credit Policy Committee of an individual bank, prepares the basic credit policy of the bank, which has to be approved by the board of directors. So CPC will prepare it. Credit Policy Committee will be preparing it, and it will be approved by the bank's board of directors. So who prepares it? Senior committee. Now this is called as Credit Policy Committee. Some banks call it different name. Okay, some banks might be having it CRMC, Credit Risk Management Committee. Some banks might be having it some credit committee. So any name can be there, but any senior committee. Okay, and it is signed by board of directors, approved. What are the guidelines in this loan policy? Means what should be the case? What should be the main ingredients in this loan policy? Level of credit deposit ratio. How much is your loans versus how much is your deposit? Again, here you have to match the loan and deposit along with the timelines also. Targeted portfolio mix means what is the portfolio? To whom have we given the concentrated loans? Concentrated means if we have given the loans to a single sector only. Okay, portfolio mix, targeted portfolio mix. Hurdle ratings. Hurdle means what? Hurdle means what are the risks involved in this? These are called as hurdles. Hurdle means risk involved. Loan pricing. Now, this loan pricing and hurdle rating are always related to each other. How? How will you say that hurdle rating and loan pricing are related? See here. I'll ask you a simple question. If some customer's CIBIL rating is 800, if some customer's CIBIL rating is 800, and there is another customer whose CIBIL rating is 600, whom will you give higher rate of interest for the loans? One customer's CIBIL rating is 800, second customer's CIBIL rating is 600. Whom will you give higher rate of interest in loans? Isn't it, Prabhakar? 600. Why? Why have you given 600 higher rate of interest? Because why did you give more rate of interest to this 600? What is the reason? What do you say? Why did you give higher rate of interest to 600? Correct. Trust. Risk. Risk. Risk is the main word. Risk. Right? Now, understand this word. Risk. Risk is everything. In banking, everything deals with risk only. So, if I have more hurdles, if the customer is more risky, more hurdles means what? More risky. If the customer is more risky, then I'll put a higher rate. So, loan pricing will be higher over there. That's why these two are related. And last is collateral. See here, there are two types of securities, prime and collateral. What is prime security? Prime security means that is created from the bank loan. Suppose if I take a housing loan and build a house, so that is prime security. Collateral means already existing. I'm having one house, then I'm taking a loan from you for some other purpose, and I'm giving this house as a collateral. So this house is already existing. So that is known as collateral. Okay. What are the five C's? Definite question in the exam. Five C's in credit appraisal. Very important question. One of them is asked definitely. Character, capacity, collateral, capital, and conditions. What is this? Character, financial character. Sure, character means you don't need to check how many marriages this guy has done, what are the affairs of this guy. You don't have to check that. You have to check only financial character. Financial in the sense, How many loans has this customer taken? Has this customer given the repaid the loans correctly? Is there any NPA? That's what we have to check. We are only concerned with finance, not the personal character of that person. Okay? How will you check this? This nowadays you get it from civil report only, isn't it? In civil you get all these things. So civil report will give you all the details. Got it? Capacity. Here, how will you check the capacity? The capacity is and capital. These two things, capacity and capital. Okay, these are checked using the your ratio analysis and your balance sheets. Okay, whether this customer DSCR, this is a basic ratio. DSCR will give you the idea whether that customer can repay your EMIs. Then capital ratio will give you the idea whether this customer is having enough liquid funds, okay, with him. Then collateral. Tomorrow if your loan becomes NPA, what is the uh, means recovery part for you? Recovery you can do. For that we take the collateral. Collateral is always existing asset. Huh? And last is conditions. Now, what do you mean by conditions? Conditions are market conditions as well as customer conditions. Means if the market conditions are bad during COVID times, market conditions were bad. So that those are known as universal conditions, market conditions, society conditions. Second is market conditions are good, but a customer's condition is bad. This can also happen. There might be some customer who might not be in a good position. So module C, Ravi Kumar, it's module C. So this part, it means that you have to check both the conditions, market situations also as well as the customer conditions also. Control and monitoring. Now this again you are having a separate chapter over here for control and monitoring. Monitoring systems for credit. How does the bank manage the credits? How does the bank control the credits? How do you monitor the stock statement? Okay. How do you monitor the financial documents of that customer? Do you get regular stock statement from that customer? Is that stock statement correct? Okay. Information systems and analytical techniques for measuring credit risk. So credit risk is measured. Credit risk means what? Default risk. What is credit? Credit risk means default risk. The customer is not able to pay. So checking every time, keeping the track whether the customer is able to pay or not. Internal risk rating system. Internal means basically your own risk rating models. You have that risk rating forms. Every bank has that. So internal risk rating system is to be checked always whether the customer will be able to repay the funds or not. Independent ongoing credit assessment, risk assessment. This is a separate chapter. Chapter number third last chapter is there. Credit risk assessment. It's also called as LRM, loan review mechanism. This is actually audit of the bank, not the audit of the customer. Credit risk assessment is audit of the bank. Okay. Prompt reporting of policy exceptions means wherever I see the exceptions, some policy is not followed, immediate reporting should be done. Okay. Earlier remedial action for on deteriorating credits. Earlier remedial means what? Nowadays we have this concept of SMA 0, 1, 2. SMA 0, SMA 1, SMA 2. You have this now? So these are all up to 30 days, 30 to 60 days, and 60 to 90 days. Got it? So SMA 0, 1, 0, 1, 2. So every remedial action on deteriorating credits, SMA 0, 1, 2. Got it? Loans. Now this was the overall topic. Now just to give you the idea, capital is of two types: promoters own capital, then share capital, and loans. This you'll be studying more in your BFM. Okay, capitals are of almost five types: authorized capital, issued capital, paid up capital, called up capital, and subscribed capital. There are five capitals. This you had studied it in your JAIB. Authorized, then subscribed. Subscribed is after this. Subscribed. See this. Subscribed is over here. This subscribed. Subscribed. This is a subscribed capital. Then you have issued capital. Then you have paid up capital. One, two, three. Paid up is here. It is between. Called up capital is in between. Called up. Called capital is in between. So these are the five levels. First is authorized capital. Below that is subscribed capital. Then you have issued capital. Then you have called up capital. And then you have paid up capital. This was in your JIB. Okay. Chalo. Let's stop over here today. Okay. Bye everyone.